what is this SIF, specialized investment funds, and how this different from mutual funds and the PMS?
SEBI regulations in 2025 February came out as a product which, while sitting within the mutual fund ages, but it allows for certain relaxations on things just for investment managers like ourselves to maybe deliver a little bit different strategy and maybe even better returns than a traditional mutual fund strategy, while taking on that additional risk in order to generate that additional return for the investor. So I think broadly that is where specialized investment funds. So it is targeting 10 lakh plus investor class. It is somewhere below the AIFs where it is 1 crore. In PMS you have the 50 lakhs. Likewise, in mutual funds as low as 500. So it's somewhere in between. It also gives an idea where they want this product to be in.
Welcome to once again our Money Any podcast. Today we have a guest from HSBC Mutual Fund, Mr. Ankit Patel. He is the head of credit research and comes with the 2 decades of experience. They have launched the hybrid long-short product on the SIF sites, and we wanted to spend time with him to understand about the product and about the industry also. So let's start.
Sure.
Thank you, Chief. Thank you for your time. Really appreciate.
Happy to be here.
So maybe just to start with, what is this SIF, specialized investment funds, and how this different from mutual funds and the PMS?
Sure. So SIFs, SEBI regulations in 2025 February came out as a product which, while sitting within the mutual fund ages, were to offer slightly different solutions for investors to invest in, right? Compared to traditional mutual fund products, there are certain variations in terms of higher issuer exposure or higher sectoral concentrations that are allowed. Shorting is also allowed up to 25% of the fund. There are redemption and redemption frequencies that are more flexible over here that are allowed, which suits certain different kind of products to be set up. There is also a notice period component which is allowed to manage redemptions in a different way. So all in all, I would say it carries all the good things about mutual funds in terms of restricting investments only to listed papers, investment grade rated papers, all the portfolio disclosures on a regular basis, but it allows for certain relaxations on things just for investment managers like ourselves to maybe deliver a little bit different strategy and maybe even better returns than a traditional mutual fund strategy, while taking on that additional risk in order to generate that additional return for the investor. So I think broadly that is where specialized investment funds. So it is targeting 10 lakh plus investor class. It is somewhere below the AIFs where it is 1 crore. In PMS you have the 50 lakhs. Likewise, in mutual funds as low as 500. So it's somewhere in between. It also gives an idea where they want this product to be in.
What's not allowed in this product when it comes to an investment?
So as I said, non-investment grade or unrated investment papers in the fixed income side are not allowed. Shorting beyond that 25% allowed of the AUM is not allowed. Leverage, which is allowed in certain alternate categories, is not allowed.
Unrated
papers are not allowed. Unlisted papers are also not allowed. I think broadly those are the non-allowances in this space.
So let's suppose, how should we explain this SIF in the simple language to the people who are well aware about the mutual funds?
I would say a mutual fund plus kind of a return with a very measured amount of incremental risk. If I were to just describe it in one line.
Okay. So I think we are coming out with this hybrid long-short funds. Can you spend some time on that, how this fund and how that fund construct is all about?
Sure. Yes, this is our first specialized investment fund strategy that we are launching. It is called the RedHex Hybrid Long-Short Fund. RedHex is our brand, stands for Red Hexagon of the HSBC brand itself. why we decided to go for a hybrid fund strategy is because it provides certain benefits from a tax efficiency perspective. It also allows a little bit of stability in terms of us being able to offer a combination of equity and a debt alpha strategy. Uh, the key construct of this fund is that it will stay in that 35 to 65% equity to debt allocation.
Mhm.
We will have to do minimum 35% equity because we are targeting a certain taxation category. But that we will keep as a pure arbitrage kind of a investment segment. It will be non-directional equity, as you know, arbitrage is,
Mhm.
and it may have a short sleeve of REIT investments as well. REITs are now classified under equity,
Mhm.
so they will have the stability that it comes with. Apart from that, the balance 65% will have a 15% liquidity sleeve and a 50% allocation to debt investments. Those debt investments could be in the A category space,
Mhm.
because the idea is to generate that alpha
Mhm.
in terms of returns for the investors from that segment.
Mhm.
So within that space, of course, we will also be open to do InvITs,
Mhm.
because InvITs also are offering very decent distributions and ultimate overall yields.
Mhm.
I think broadly that is where it will be 35-65, with space for REIT, with space for InvITs, with a space for A category exposures, and good amount of liquidity available from the arbitrage and the AAA sleeve.
Mhm. So you said that there is no directional equity in this product.
Yes, yes.
Why that choice you have made?
So as I said, the good part about SIFs and the target audience, I would feel,
Mm.
are audience who have 10 lakh is a
Mm.
decent amount of investment which is coming from a surplus.
Mm.
They are not. This is the target segment. Probably people who are not looking to see multiple percentage growth. They want to protect their capital
Mm.
and want to generate some alpha over and above the regular risk-free return
Mm.
in order to manage an inflation adjusted return for themselves.
Mm.
So this is why the staying away from the long equity over here. And then there are other strategies where they can allocate to equity oriented strategies. So we are
Mm.
offering a solution. The idea is to offer them something uh, which is giving them a fixed income kind of a flavor
Mm.
in terms of their investment. So
Mm.
it's an asset allocation option.
Mm.
If they want long equity exposures, I'm sure a lot of them are already allocated to it.
Correct.
This is the section where they should target to get a more stable and less volatile kind of a exposure.
Mm. So can you also brief about the construct of the product? You already said in terms of you have arbitrage certain sections, and then you have a 65% which is debt. Why that construct? Why do you think that construct is important? And
Mm.
what was the logic behind building that construct? And who are the maybe a target segment what we are looking for?
Sure. So I think the reason for the construct to be 35-65 is because we are targeting SIFs are a listed security.
Yeah.
Uh, the SIF that we are launching, hybrid long short, will come under the non-specified listed mutual fund security space.
Mm-hmm.
And the idea is to achieve that tax efficiency in the product,
Mm-hmm.
where it will be eligible for a 1 year LTCG taxation under equity,
Mm-hmm.
12.5% plus cess plus surcharge.
Mm.
Which is why minimum 35% of equity exposure in the fund,
Okay.
because that makes us eligible for that taxation efficiency. Apart from this, I think in terms of the target, as you are asking, I think the target is, as I said, individuals who are looking for stable returns,
Mm.
maybe get a little bit of negative correlation going in their portfolio as compared to having a very high proportion of equity
Mm-hmm.
in their fund.
Mm-hmm.
Right, so a negative correlation to market volatility.
Mm-hmm.
If they have exposure to equity markets, as we have seen, it can impact the returns in the short term. But fixed income oriented products, where the relation to market volatility is lower,
Mm.
will continue to earn a accrual based kind of a earning,
Mm.
and it can give them that additional, as we are saying, it is a missing piece in the asset allocation of many investors,
Mm.
and we feel this product will provide that tax efficient uh, accrual product for their portfolio.
Correct. Can you also spend time? Why do you construct that debt allocation, which is almost like a 65%,
Yes.
where you will have 15% allocation in GSEC, which is high rated papers. You will have 50% allocation in maybe a single A plus sort of papers. Why did you thought such kind of constructs? What's the thought behind that?
Right. So under the fund construct itself, we are not looking to go above 65% on debt because you have to be
Correct.
minimum 35% equity.
Because, yeah.
Now within the 65%, we wanted to generate alpha for investors and maintain liquidity and the margin requirement for arbitrage, which is also there.
Correct.
So it was a decision as to what proportion should we keep would be safe in terms of taking that exposure to the AA category space, which will give that credit spread and higher yield component in the fund. We decided as as a house that let's maintain at least 15% of that 65% allocation in AAA, GSEC, corporate PSU, safe exposures, because that will add to my 35% of arbitrage as a total 50% of a stable, non-volatile section of the portfolio,
Perfect.
which will keep giving stable returns.
Yeah.
And the balance 50%, we will do the alpha generation as we want in this portfolio. So it's a 50-50 mix. And that appeals to us as a product construct that we have 50% which is giving me benefits of liquidity, stable return, and we have 50% which is targeting a alpha in the strategy. So it's a good mix. Gives us a good manner of circling back and re-looking at the portfolio from time to time, but overall remain within this construct of 50-50.
Great. One question might come that how risky this double A, single A paper bucket.
Right.
Like if you can just throw some light on based on your 20 years of experience.
No, sure. Very, very important. The key risk component in this fund is the limited credit risk that we are taking, right? So, investment grade category starts from triple B. There is triple B minus, triple B, triple B plus. What we are targeting is the A category and the double A category space. Median A plus kind of a overall rating bucket. We are targeting PTCs, which are credit enhanced structures. The default rates, if you see, today we have a 4,000. I was just looking at the numbers. We have almost 4,000 plus A-rated issuers in the country. It's a relatively less penetrated space in terms of the capital market exposure, and to that extent, the yields that they offer are also higher. It may not be a true reflection of maybe the credit quality as such. It is simply access to capital markets, which actually determines that they allow a higher yield when we participate in those papers. So it's a measured amount of credit risk. The default rates in A category are quite minimal. We have a 0.2, 0.3% 10-year cohort kind of a history of A category default. The credit risks to that extent are also compared to a double A category, 0.1, 0.12 space. This is jumping to 0.2, 0.25. So it is just a slight increase, but not to the extent at which the benefit is coming on the yields due to various inorganic components that are there in our capital markets. So the opportunity is there. The number of issuers who are ready for capital market issuances in the A category is also there. A lot of these papers are already being purchased by PMSs, wealth channels, family offices, corporates from time to time. It is just that we feel it's an opportunity which we should also harness and maybe pass on to our investors, because while the credit risks are there, given the fund construct that we have decided and the kind of strong liquidity that we are maintaining, I think we are well placed. We also have a long track record of managing funds. We were one of the larger credit risk fund and credit managed portfolios in 2018-19. So we have the experience. We have had a very good run in terms of our credit management in the last 5 to 6 years. We have no zero downgrade, zero down defaults, etc. And we will follow a very measured approach in terms of we have an internal rating, credit rating framework. We do not rely on external ratings and do our own credit work in terms of this. We have experience of looking at all of these term sheets, trying to see the finer points in terms of how we can have our specific clauses when it comes to exposures. So I think experience is there in place.
Mm.
This was difficult possibly to carry out in the mutual fund space in the manner in which we can carry out in an SIF, and that is where I think that experience we will put to use.
Again, you touched upon, because it's a debt-heavy sort of construct. And again, you touched one risk, which is credit risk. Another risk which comes as an interest rate risk also. Do you think that the construct what we have, one can also see a interest rate risk?
Correct. Very interesting. In fact, we did think about it at the point at which we are in the rate cycle with rates going up and the nature of exposure that we are going to take. So one of the ways in which you can limit your credit risk to slightly lower papers from a AAA space is limit your duration.
Correct.
Right. So in any case, we are looking at duration exposures around that under 2-year mark, 1.5 to 2-year mark on duration on all of these exposures in the credit space. The second thing is we are having a component of REIT and InvIT in the portfolio construct as well, which give quarterly distributions. So you have money coming back to, of course, there are also PTCs that we are targeting within this debt space, about 10 to 15% of PTCs, which have monthly cash flows, which bring down your duration even further, right? So, and another thing to note is credit space, while it may have a correlation ultimately to the overall rate cycle, the direct impact and the straight translation of impact is lower because there are more components at play. There's demand supply at play, there's liquidity of these papers at play. So the overall impact and translation of the rate cycle to credit names is generally a bit lower. In any case, our duration we feel on an overall fund basis will be around 1.5 year mark, and we keep reinvesting the capital. So we will not at any point be too far away from the prevailing rates in terms of reinvestment risk. So I think that should manage duration risk to a large extent.
Correct. So, would you like to deconstruct how the return you derive from all these components basically, and how on a portfolio level, though yes, for a mutual fund they are not guaranteed return products, but you can have some visibility how this portfolio constructions based on what sort of yields they derive.
See, I think on the 50% stable section, we know that current levels of arbitrage or of GSEC portfolios or AAA PSU, they could be generating whatever around 7.5% odd. And we know the alpha section of A category rates are prevailing anywhere between 9 and 12% on various A category papers. The idea is a blended return of the fund will be a blend of these two, half and half.
Correct.
And the taxation impact is where we will actually get the maximum benefit because compared to a slab taxation of almost 39% for a HNI, the largest tax bracket, if you are getting a capital gain benefit at 12.5% plus surcharge and cess, you are at 14.95%. So there's a 25% benefit coming to you only from the tax saving.
Perfect.
So broadly, this is more a product where you get the benefit of both the alpha generation from credit exposure and the alpha generation because you are having a tax benefit.
Correct. So both the benefits, one on the tax benefit and the portfolio construction, which is difficult at the individual end. It comes in an institutional format basically.
Yes.
Great. So what are the biggest risks investors should understand before investing in any SIF sort of product?
Sorry, come again?
So any risk investor has to emphasize before committing any investment to the SIF?
I think one is you have to look at these strategies as they come with a slightly different flavor compared to mutual funds. I think disclosures and the commitment and how the mutual fund is going to play out that SIF strategy is important. If you are not happy with shorting, you should probably stay clear with shorting strategies. For example, we do not at the moment have plans to do shorting.
Correct.
Zero shorting is allowed by SEBI. So those kind of things, if they are not comfortable to the investor, then obviously there are the regular risks. In fixed income, it would be your duration risk, the credit risk, the liquidity risk, reinvestment risk, etc. In equity, obviously it would be sectoral risk and obviously the business risks involved. In general, I would say the broad asset allocation that the strategy is targeting will give you a clue as to what underlying components are going to be there, and and the communication will give you an idea as to what are the key elements of risk in this particular fund. Uh, Also, the target customer target positioning of the fund will give you an idea that this is a capital protection fund. It is likely to have stability, likely to give you less volatility, or it is something where there's going to be higher risk taking in order to generate a much higher return. So, I think those things are important before an investor decides.
So you answered my next question, but in halfway is basically
Okay.
ki, who should look for this product, and who should this product is not ideal for those clients. So one is already you said that this product is basically someone who is looking for less volatile or maybe non-equity sort of allocation, stability of the portfolio,
Right.
plus gives you a taxation benefit.
Yes.
Who should not look for? Who is not the target audience for
I
this
think
product?
target audience is somebody, I feel, who doesn't want to park money for 1 year because you could lose the taxation benefit.
Correct.
You fall down to the slab rate. So somebody who is not looking to park at least for a 1 year horizon should ideally not be here. Secondly, I feel somebody who has very high fixed income allocation anyway may not be looking at this, because if he is already allocated to regular fixed income, which is of a lower yielding category, he is obviously risk averse to even the slightest of additional risk. A third person, I feel, is somebody who is really looking to make a very high amount of returns. Equity, like very 15-20% kind of a return over a period of 3 to 5 years. That person should possibly stay away. Ideally, I feel the product fits in for people who are already over allocated to equity. Right, and they want some stability in their portfolios and want to maybe change their asset allocation given at what place they are in their life, at what age they are, whether it is the right time to keep doubling your money, at least target doubling your money in every 3 to 4 years, or also have some stable component which provides you liquidity, doesn't give you negative returns, more often doesn't give you negative returns, and gives you stability in your wealth. I think that would be the target customer.
Another question I wanted to ask. So this is one strategy which is coming. I have one question to ask, but somehow I just forget.
Okay.
So this is one strategy. Within the hybrid, we have another category also. That is also you have some plan to introduce in the meantime.
So there is a asset allocator hybrid strategy which is there. As of now, we have not looked into that. Our entire focus is on this particular strategy for now. But we will look to see if we have some because we will keep reworking and thinking as to where there are gaps which we can identify, like we did in this case. And you know that already there are multi-asset allocation strategies. So the asset allocator is to operate in that way. The idea is to provide some differentiation. If we are introducing a SIF product, hopefully we are providing something to the market which gives some differentiation compared to already what is existing in the mutual fund. So when we see that opportunity possibly with that asset allocator as to provide some different strategy, we will actually probably
and
will
this product offers that. I think it's a one of its kind within that the existing hybrid long short category. The one question which I wanted to ask, which I was not able to collect, is on the redemption. I think this is important to disclose the if someone is coming and wanted to have a redemption or exit from this fund, how it works basically. So if you can elaborate that side also, it's an important and crucial aspect.
It's a very important aspect of the fund, and it is thanks to the SIF regulations that some of the things that we want to do, we may be able to do in this fund. Redemptions as SIF allow are at a different frequency than, so it's not a pure open-ended fund strategy. They are interval strategies.
Correct.
So subscription is daily, but redemption that we are offering in the fund is weekly. Every Monday of the fund. Many of the SIF strategies are offering twice a week, once a month, once a week. It is allowed as per regulation. The other component is it's not just once a week redemption that is to be seen. There is also a notice period involved to fund the redemption. So if a redemption comes to us on Monday,
Hmm.
the NAV that will be applicable for funding will be 10 working days post that Monday.
Hmm.
So the investor doesn't lose the accrual for that 10 additional working days, but he has to wait for that period in order to receive the funds.
Okay.
And that's an important component because debt markets in India, the limit, the depth in terms of being able to generate liquidity, we have kept some room for it. Unlike an exchange traded security, debt markets are OTC, and
Yes.
often it can take 1-2 days, or it can take a few days to, if there are significant redemptions, to manage the liquidity of the fund.
Okay.
This kind of a line of sight in terms of us being allowed 10 working days to manage liquidity only protects the existing investors in the fund and allows us to also generate that liquidity in the most efficient manner.
Correct.
Because the papers would be good, there would be buyers, but unlike an exchange where anybody can, it will be over the counter and it can take some time in order to find that buyer. And hence we will not be able to, we will not be able to lose a lot of value while trying to force sell or force generate liquidity.
Okay.
That's the flexibility which is needed from an investment management perspective. And anyway, people are supposed to expected to stay for 1 year. That they can keep a 2-week window before they want to receive the funds.
But the construct is kept in mind to look at the times which comes in a worst period of time.
Correct.
So you have to make sure that in the worst period of time, I think you have to manage these things without giving any negative sort of experiences to them.
Absolutely right. That's without impacting the staying investor, without impacting the fund, without creating a more systemic issue when a situation like that arrives. As you know, the fund has liquidity. However, we are keeping ready for possibly a situation like that. And honestly, as fund managers also, investment managers, it allows us to rebalance the portfolio because you have to continue to maintain that 35-65 kind of a mix also. It allows us to rebalance the portfolio, maintain the strategy. And we also can say that short-term investors may find this a little bit of a difficulty, and hence only long-term investors will come participate.
And one thing also look at, this is not a pure equity product. This is a more of a debt sort of product, debt heavy product sort of.
Yes.
Maybe if what is the probability of negative returns, or in what circumstances the product may not able to deliver the returns? Basically, is that probability? There is a, but in what circumstances?
Compared to, I would say, the volatility that you see in equity markets, there is less possibility over here because it's a everyday coupon earning accrual product to a large extent. Arbitrage is also like that. You keep earning on a monthly basis. The slight, I would say, the impact that can come is because of the fact that any REIT and InvIT exposure, which we have kind of kept short sleeves of it, can give you some impact of market volatility, but they are hybrid instruments. In general, they have a value underneath, and they cannot be far off from that underlying value. So there is always that they will not see the same kind of volatility that you typically see in a long equity position. And the rest of the fund is anyway not expected to see that market volatility. The other thing that can impact is duration risk. I mentioned earlier, duration risk is limited over here because of various aspects. So I would generally look at this product as something that should see much less volatility, which you could derive from an equity market or from a long duration debt fund. Because of say GSEC or risk-free rates changing over time, I would see that that those risks are limited over here, if at all. And generally, you should see that the coupon accrual on a continuous basis should result in through the NAV accrual as well from a time-to-time basis. So for NAVs to be impacted significantly, the sleeves that have a high volatile component are fairly less.
Correct. So if you want to summarize the product offering what we have, can you summarize us for maybe in next 1 or 2 minutes? The product.
So I think it's as such, it's a hybrid fund. It's a I would say it's a less volatile and in the current uncertain volatile environment that we are in. I think it's an option for investors to probably get back to that missing piece of their portfolio allocation.
Yeah.
A lot of investors actually moved away from products that often had a good amount of fixed income component to it. But at the same time, this product which comes in from our side, we've tried to plug that gap in the market, and it will offer a very healthy, tax efficiency also, so that the investor maintains a lot in the post-tax and in their hands, with the exposure to a limited amount of risk, I would say.
Correct.
And so risk-adjusted returns in this fund should be good. Ideally, people should look at this fund as a missing piece of their core asset allocation. It should be a part of their core asset allocation, which gives them negative correlation to market volatility, continues to maintain a stable, healthy return, even when equity markets are very volatile. And broadly, that's it. It's a core asset allocation piece that maybe may have been missing, and will help them to broaden and continue to maintain their wealth in the long run.
Yeah, I personally agree. I think most of the time people skew towards one asset class. Post COVID, I think people are extremely gung-ho on one asset class. I think this is one asset class which give them stability in the portfolio. And maybe and last maybe couple of years, because of the taxations also, some of the maybe the high net worth individuals, the composition of the portfolio is skewed towards a risky or more volatile as an asset class.
Okay.
This product offers stability with the tax benefit. And really appreciate, Ankit. Thank you for your time.
Sure.
And thank you for the detailed your views on the product. Really appreciate it.
Thank you very much. Thank you to Manihani for this.